Today we're going to talk about capital control. What is capital control and why is it important? Certain countries have capital control, meaning they don't allow the free float of capital in and out of their country. There are certain restrictions that they don't allow capital freely to move in and especially out of their country. Why this is a factor to determine the free being a country be free market economy or not? Because in a promotion of free market economy, the US ask other countries to don't have capital control. I'm going to explain why not having capital control might be beneficial for certain countries, but not for all countries, and why capital control is always beneficial for the American economy because the US could print the global currency, the world reserve currency, and by having this power, not having capital control allows those capital that are outside of the US freely come to the US. But this is not the same for other countries. Other countries, they only print their own local currency. Their own local currency is limited and is scarce, means they cannot print as much money as they want because they cause hyperinflation. So what happens then is because they don't have power of printing global currency, if in case there is global uncertainty and global economic uncertainty somewhere in the world, the capital move out of those smaller economies in a pace that destabilize their economies. So if those countries that have smaller economies, like global south countries as they call it, if those countries don't have capital control, they be prone to financial attack. It means many investors suddenly take out their money and the capital flow in a rate that destabilizes the economy. There are historical precedent for that. For example, in 1997 Asian financial crisis, certain countries like Thailand and South Korea and few other Southeast Asian countries suffered from outflow of capital from their country, and the economy destabilized and the economy was hurt. But certain countries did not accept or did not listen to the advice of American economic elites that you need to not have capital control. And one of those countries that did not listen to those advices were China. China kept its capital control. Because China kept its capital control, they were not hurt by 1997 financial crisis because they had certain restriction and guardrail that don't allow the sudden outflow of capital from their countries. Why this is important for different economies to know, and why this is exactly like the previous subject that we talked about in the previous video, why free market economy may be good for the US, but not necessarily good for other countries. Exactly like the previous subject that we talked, having a free market economy for smaller countries could be hurtful to their economy because the capital could flow out of their country at a rate that could be destabilizing. At the same time, free market economy is good for the US because always want to create a situation that the capital, the dollar that is outside the US, flow back to the US, but is not necessarily the same for smaller countries. Thank you.